Good afternoon, everyone. We'll wait for a minute or two for the participants to join in, and we'll start the session. Thank you.
You're on mute, Adnan.
Adnan, sorry, you're on mute.
Good afternoon, everyone. I would like to welcome all the participants on behalf of ASK Investment Managers to the first edition of its knowledge series on ASK Specialized Portfolio. I, Adnan Beg, part of the business development team at ASK IM, would be the moderator for the call today. And the session will be addressed by Mr. Sujit Jain, portfolio manager of our ASK Specialized Portfolio. And he will take you through broader economic trends, ASK Specialized Portfolio highlights, and way forward. So Sujit has an overall experience of 15 years of equity research in domestic markets, including 4 years in fixed income markets. His main domain expertise is in industrial sector. Prior to joining ASK, Sujit has worked with HDFC Securities, Yes Securities, Asian Market Securities, and Pioneer Group. Sujit is an MBA Finance from Indra Institute of Management, Pune, and has FRM and CAIA accreditations. He is with ASK IM since March 2018. So the session will be followed with a round of Q&A. So I request you all to type your questions and queries in the chat box for the Q&A box. We will try and get them answered by Sujit. I now welcome Sujit to take things forward. Over to you, Sujit.
Yeah, thank you, Adnan. So I'll straight away get into some of the issues or some of the news flow that the market is facing. So, for example, the Fed testimony in front of the Senate has happened, and clearly Fed has spoken about higher and faster Fed funds rate. If you see also, there is an inversion in yield curve in US that has been there for some time. It happened in India as well yesterday. So in US, you have 10-year, which has crossed 5% and 2-year crossed 5% and 10-year, which is at 4%. In India, you had 1 year crossing 7.48, whereas 10-year is at 7.46. So there are concerns regarding this inversion of the yield curve also. You've had the Fed fund rate increasing to close to 4.5%. Next meeting is due in March 21st and March 22nd, where now with the commentary that the Fed is given in his testimony, it looks like the expectation is of 50 bips. And more importantly, in the last December meeting, they had a kind of projected a 5.1% as the upper end of the rate, which now people believe that in the upcoming session, it could be up to about 5.6%. In India also, you've had rounds of increase close to 2.5% in the repo rate, and there is further to go. The expectation with these developments is that inflation will remain elevated, and plus in US, earlier it was expected that come December 2023, they'll start a cycle of even cutting rates. Now, the expectation is that the interest rates will go up and remain elevated for longer than expected, which means that this expectation is now pushed back to FY24. So there are definitely news flows which kind of are negative, including I'll just quickly touch upon the growth rates globally. There is some chatter around recession, though the outlook by institutions such as IMF, etc., is not in that direction. India clearly stands out in FY23, 24, and upcoming years. But more importantly, to me, when world growth kind of slows down, it benefits India in terms of the crude oil prices, which is the largest import bill for India. When energy prices come down, and which they have come down from the top to about $80 to $83, it benefits India. And our share of global exports, merchandise exports, is very minuscule. So typically, movement up and down in terms of global growth rates does not impact us that much, because our increase in overall export pie of the globe comes basically from market share gains. So to that extent, what is happening in the world in terms of growth rates or lower growth rates may not materially impact much in India. Some sectors, of course, will get impacted, such as IT sector, where you see there is a good weight of that sector in Nifty, etc. In terms of the recent developments, when you see what happened in last year, CY22, and even in the 9 months results of companies in India that have come, you would have seen that there was volume pressure, and as well there was a margin pressure. Some of that has clearly cooled off. Commodity prices have come off. Oil prices have cooled off, as I've just mentioned. Supply chain has definitely normalized, both in terms of the time it was taking for shipping goods from destination A to destination B, and as well as freight rates, which had really skyrocketed. They have corrected meaningfully and back to their normative levels. If you observe companies and their contracts with their clients, clearly freight was not a component that was covered, and definitely not to that extent, not to the extent to which the price rise happened. That impacted the margins. Freight rates normalizing now will basically have companies reverting back to some of the lost margins because of this. On our mind, the recent news flow of El Nino effect is definitely there. With a 55-60% probability, clearly there is a risk in terms of both inflation and rural growth getting affected if that plays out. Plus, you've had 4 normal monsoons, and statistically, a 5th normal monsoon has not happened in 60 years. So that is just a statistical, data point. It may not, or it may play out. It depends. But clearly, the El Nino earlier forecast and projections pose a risk in terms of already slowed down rural recovery. Having said this, in this particular portfolio, we don't have much of rural exposure, but that will definitely have sentiment impact on the overall markets. In terms of our CAD and our forex position, you look at our neighboring countries, smaller countries, so such as Sri Lanka, Pakistan. You look at Africa, you look at Egypt, you look at, for example, Turkey, etc. These countries clearly faced issues in terms of not having enough reserves to pay for their imports, and a lot of volatility, inflation, and supply of essentials getting curtailed, etc. India did not face that. One reason for that is that over the years, the compounding in IT sector, the way it has happened is that today IT sector alone brings the required dollars to meet the import import bill of crude oil. Also, I quickly want to point out is that 10 years back, when oil prices rose the way they've risen now, we had a situation where, if you just see this graph, clearly there was an issue for us, which today, like I said, this sector is easily able to meet our requirement in terms of the import bill of crude oil. There are, of course, other key large item in terms of our import bill, But at the same time, if you look at the trajectory of certain sectors in India, which are small in terms of exports today, so such as API sector and the upcoming EMS sector, eventually one can foresee they will become substantial contributor to the dollar inflows that India can have. So to that extent, our position is getting stronger and stronger by the day because of some of these sectors. As you've seen, better compliance because of the digitization initiatives the government has taken. GST compliance has been better. There is some momentum in the economy, and 1,40,000 tons of rupees of collection every month that has continued. Strong PMI data. You had credit growth which was muted for a decade. These are long cycles that has now improved. Some of the key indicators such as high-speed diesel consumption has remained elevated. So quickly to take you through the construct of the portfolio that Specialized is basically we look at any point in time 14 to 16 best ideas bottom up and supported by themes like China plus one, which today even Europe plus one is playing out. So specialty chemicals is one such theme. Migration of value from unorganized to organized sector, migration of value from let's say PSU to private banking. As India grows its per capita income, the growth in consumer discretionary will be exponential. So I'll eventually come to psychographics of this particular portfolio, where you can see is that compared to the benchmark, which is Nifty 50 for this portfolio, the weight of consumption and financial sector, especially consumption sector, is definitely higher in the portfolio compared to the weight that it carries in the index. So some of the things that I just spoke about lead us to our stock picking, which I just said 14 to 16 stocks that we typically look at. The criteria that we lay down is that 20% annualized earning growth and 25% ROC are the companies that we are looking at with a reasonable valuation, so that we might get some re-rating plus the compounding and secular earnings that these companies generate. That much return that we can pocket. That's the idea behind it. At the same time, this being a concentrated portfolio, because today it is sitting on 15 stocks, so each position can become the normative weight of a position is close to 7%. Each position starts at 7%. To that extent, it is concentrated. To that extent, it is more volatile on the down markets. On the upside also, it swings back faster than the market. And to that extent, the risks are there. While this portfolio is constructed to generate better alpha, clearly the way we play is risk before returns. That is always there on our minds. And to that extent, we've put a PBT criteria of 100 crores for trailing 12 months as the initial filter for companies, so that companies would have come up to a certain scale and should have had a particular track record before we bring them in terms of even our consideration. Like I said, we look at quality of business, quality of management. Clearly, we believe is that is a multiplication. If one goes zero, the multiplication becomes zero. Both are important. We need a certain longevity of earnings and the quality of earnings rather than very fast growth rates, but for a lesser number of years. We would rather prefer a little lesser growth rates compared to the scorching pace of growth rates that we saw in some of the sectors. For example, earlier in the platform companies, etc. We would rather want a secular and high quality growth. High quality meaning, the ROCs of the companies that we choose should be superior and at a reasonable price. And then when we screen those stocks, the mandate is to invest into 14 to 16 businesses. Coming to psychographics of this particular portfolio, like I was mentioning, consumption clearly is a higher weight in this portfolio. And we have, consumer durable stocks, the cable stocks, which have done well. In fact, CY22, we have one staple stock which has also done well in CY22. Then we have Page, which has done well in CY22. Some performance has been given up in the current quarter, that is in CY23 first quarter. In financials, obviously the index weight is much larger. compared to that, our weight is lower, and to that extent, some allocation effect comes in play when financials do well. We also have a good exposure, much higher exposure compared to the index. So, for example, here we have APL Apollo, which has done well for the portfolio in manufacturing. We have Dalmia Cement, which has also done well last year. The chemicals exposure, as I was mentioning to you, is because of the theme that we believe China plus one and as well as Europe plus one that is playing out for India. There are two chemical names here. Then we have exposure in telecom through Bharti, some software tier one exposure, because we believe is that ultimately vendor consolidation will benefit the tier one players more, and one PSU gas utility out here. In terms of the way we look at it is that our portfolio will generate higher EPS growth compared to the index. If you look at last 4-5 years also, the growth in earnings in terms of compounding has been close to around 18 to 20%. These are not levered companies, as you can see in the fourth row, which is debt to equity. So typically the expectation in terms of or the cost of capital for these companies, if we peg it at anywhere between 12.5 to 15%, then we would want these companies as a set to generate better ROCs. So that, so for example, 15%, and in this portfolio, you can clearly see 27% as a group for all the stock and 29% ROC FY24. So that the gap between the two, that is the ROC and your cost of capital, is the amount of money that is available for companies to redeploy, reinvest. And within that also, we typically would love companies who can and who redeploy 50-60% of their cash flow from operation back in the business to fuel growth. And with that, the EPS growth expectation of 22 and 23%, which is higher than the Nifty EPS growth expectations of about, I think, 12 and 15%, depending upon which number you are looking at for 23 and 24. And then, like as mentioned, one might get some re-rating, one might even get some de-rating at times. But with the compounding in earnings, one generates a decent return, and that is the whole idea about the way we construct this portfolio. Q3 has been good for the portfolio. As you can see, the sales OP and PAT has been higher than what the Nifty sales OP PAT numbers were that came out. And as I was mentioning, FY23-24 also, you can see we expect these companies to do better. I'll quickly move to the returns that we've generated. These being concentrated portfolios in the down years, they can move much below the rate at which the indices move. The good part about this portfolio is that in many drawdown years, the drawdown in this portfolio, despite it being a concentrated portfolio, was lesser than the indices. 9 out of 13 calendar years, it has outperformed. And that too, if I look at carefully, there is a large single client in this portfolio that was there and which had put freezes on some of the stocks, because of which the overall scheme performance did not reflect the model portfolio. If I look at the model portfolio performance, then this 9 becomes 11 years. So practically out of 13 years, 11 years, this particular portfolio has outperformed. CY22 has been a tough year. With Russia-Ukraine war in Q1 of CY22, there was damage, and 3-4 positions with weightage of close to 5 to 6% basically went down, and it got accentuated in the month of May and June. But like I mentioned, eventually in June, July, August, and September, the performance came back. Nonetheless, there was underperformance. The underperformance came mainly from a few stocks, so such as, for example, we had Metropolis, we had, for example, India Mart, we had Vaibhav Global. So some of these stocks kind of contributed to the underperformance, of which we've exited Metropolis, India Mart, Vaibhav Global, etc. Some of these stocks which went down and eventually came up, for example, was, for example, Dalmia Bharat, which kind of went to 1200. But at that point in time, we decided that it was available at that price at 8.5 times EV/EBITDA. The narrative then was about entry of a large group with their purchase of Ambuja, and it could have impacted the volume growth for the entire sector and consolidation. But we clearly believed is that that narrative will eventually die down, which it did, and the stock came back. In terms of contributors, like I just mentioned to you, some of the contribution in terms of returns that happened in this portfolio came from Patanjali, PI, AU, APL, and Page in CY 22. As you can see, YTD February 23, the performance is better compared to Nifty. If I look at FY 23 performance also, this underperformance has come down because of the performance that the portfolio has generated in the month of February. So from what you can see in CY 22, now it has come down to close to trailing by 2 to 2.5% compared to Nifty. And the way things are going for some of the top positions, it could be bridged even further. I think that is about the commentary that I would have liked to give. Now we can, Adnan, move to Q&A. Thank you.
Sure. Thank you, Sujit. So I can see a lot of interest among the participants towards the specialized portfolio from the questions that have been received. So to start off, Sujit, can we understand the difference between specialized strategy versus other ASK portfolios and how it's positioned?
So two things in terms of parameters, like I said, in some schemes, the PBT parameter could be lower. Like I said, here the PBT parameter, which has been set the highest for any scheme in ASK, is at 100 crores. Because like I said, while we try to generate additional alpha, we clearly are mindful of the concentration that the portfolio has. So concentration is the USP, but it can cut both ways. So that is the reason any parameter that you see, the parameters are more stringent in this portfolio. Like I said, the PBT criteria is 100 crores. That is one. Second is there are certain schemes in which the parameters are of growth and ROC are 15 and 20%. Here it is 20 and 25%. The portfolio differentiates itself with the concentration, and to that extent, it brings more volatility both on the downside and upside. And finally, the way to look at this portfolio is that at any point in time, its weightages compared to the benchmark, in this case Nifty, you can keep any benchmark for that matter in your mind to compare this with. Even if you keep BSE 500 in your mind to compare this portfolio with, the benchmark weights of particular sector and benchmark weight of this portfolio at times materially differ. Because the way we look at it is that at any point in time, what are the best ideas that one can look at? And that is the way we select. We look at themes that we like, and within that, we look at market leaders, companies which are gaining market shares vis-a-vis competition and focusing on volume growth are the companies that we choose. And if you look at the mix of large cap and mid cap in other portfolios of ASK, here is a portfolio. This portfolio is typically not by design, but because of the choices that we've made all these years, has been more mid cap centric. So currently, close to 65%, two-thirds of the portfolio, as per the latest last definition of SEBI, will fall in mid caps, and rest of the portfolio is large cap. Right now, I just have one small cap position, but that is also nearing in terms of market cap, and the way it is compounding earnings will soon enter mid cap. So these are the differentiating factors with the other ASK portfolio offerings that we have.
Thank you. Sujit, like you mentioned that with interest rates expected to continue being up, so what is, how has calendar year 22 fared till now for the portfolio, and how do we see these underlying businesses perform in the current calendar year?
So two things, it did impact CY22, our performance. What happens is that, growth is scarce. Even in India, when you look at our universe that we look at, broader universe is close to 200 companies. Our choice of companies, if you look at across ASK portfolios, we would have anywhere between, let's say, 55, 56, 58 companies at any point in time. These are very high growth companies, secular structural compounding stories. These cash flows got valued at significantly lesser discount rates because of the zero interest rate regime that was there. So same cash flows got discounted at much lesser rates in your DCFs that people calculated. When interest rates moved up this sharply, like we just mentioned, 4.5% increase in US Fed funds rate in 11 months, 2.5% increase in India recently. Consequently, the discount rate that you are applying to the same cash flows also went up. So these companies took the maximum brunt in terms of the valuations that they traded through CY22. Having said this, these are companies which are clearly benefiting from any downturn scenario. I'll just give you one quick example. APL Apollo during COVID, without the market increasing in absolute volumes or revenues in the overall market size, gained market share of 8 to 10%. These are not audited numbers. This is an estimate. They would have moved from 42 to 50% in terms of market share. And imagine a company doing this in a single year. It would take like 7, 8, 10 years, a decade for a company to move market share by 10 percentage points. The point here is that it could do it because the smaller players were under stress in terms of arranging working capital to do sales in COVID period, and they faced greater difficulties. So in a market that kind of shrank, companies such as APL Apollo increased their market share. So obviously, in the short term, there was some pain in CY22, but the earnings of our companies are panning out. I just showed you even in Q3 that has happened. So in these times when the demand was muted in Q3 and Q2 as well, if you would have seen of consumer discretionary and consumer, etc., volume growth was muted, margins were impacted. But in this scenario, if the overall position of a company is getting strengthened, it does help. So to that extent, what got suffered because of higher interest rates, there is a certain correction that has happened. To that extent, these things have become more attractive. As their earnings play out, eventually the translation of those earnings will play out in the marketplace in terms of compounding returns. So I believe is that phase of interest rates going higher, which impacted CY22, while it still continues, the pace will come down, and it's basically simple statistics. Eventually, these high inflation numbers will become base, and on that base, the inflation will start tapering off, and that will help these companies.
Thank you, Sujit. A lot of takeaways from that insight. So I'll try to club in the next question. There are two different questions. I'll club it into one. So an interesting part of ASK Specialized Portfolio is that it's going to complete 20 years in June this year. So how has the portfolio concentration of 15-16 stocks helped in the performance? And what are the recent changes that you might have done in the past 6 months in the portfolio?
Yeah, so the concentration has helped the portfolio beat the indices if you look at longer period returns of 5, 7, 10 years and since inception. What you see, like I mentioned, there's a difference between what you see in terms of published returns because of the peculiar fact that I just mentioned in terms of a large portfolio having frozen some of its holdings. It kind of impacted the overall scheme level performance. But the actual performance that the clients would typically get is the model portfolio performance, which is better than what is getting published. And this has been corrected now that portfolio has also been aligned to model portfolio since recently. In the recent times, what we have done is that we have weeded out some of our mistakes. So, for example, when we realized some of the stories did not play out the way we thought they'll play out, initially they did play out, but eventually in some companies disruption happened, in some companies the judgment went wrong. We decided to basically exit those positions so that that capital gets freed, and then you're free to basically deploy that capital and then hope for making returns from those positions. So, for example, we did well in Metropolis for some time. We entered at a price and price multiplied. And in our mind, it was a secular story. Though I've exited it, in my mind still is a secular story for the listed companies, which are two basically prominent companies. And there are further more companies into this sector. But what happened in the interim was the competition that came from disruptors such as Tata 1mg, and they started putting their offerings at a much significant discount to the offerings of the leaders of path lab space, which are listed, such as this company and as well as Dr. Lal. Plus, COVID business died down. There was a pressure on volume, and now last 5 years, there is hardly any price increase these companies are able to do because of the competition that they've had. It could impact their gross margins and their operating margins. So this is a decision that we took, that at least I took that point in time, is that clearly in terms of disruption, it created a new dynamic, and it was better to, concede to that fact and take a retreat, and we exited the stock, and then we invested after that into KEI Industries, for example, which has done well in cables and wire, especially B2B business, which has done well in 9 months. And there is a translation in terms of stock price return also from the price we've bought. Apart from that, we would have exited India Mart. India Mart, clearly, the way we thought the conversion of SMEs into their digital journey was slower than what one would have expected earlier. That was number one. And their margins came down post-COVID. In COVID, because there was no fleet on ground, you could not deploy your fleet on ground that point in time. Plus many other expenses, travel expenses, etc., had come down materially, and to that extent, margins just shot up. Management had guided lower margins, but actual margins, when they started redeploying field force, and when the actual cost came back, actually came lower than what we expected. We exited that position and redeployed that money in Bajaj Twins, which have been kind of decadal, really long-term holdings for us. We exited some of the stocks like Weibo Global, which obviously, when the revenge travel and people going out happened, it impacted their funnel conversion in terms of the customer shopping on their network, and we found certain gaps in terms of business model, and we exited. We also exited ICICI Lombard, which for some time, because of one reason or the other, has not been able to generate the kind of combined ratios and ROEs that they initially projected. So these are some of the changes that we've done, Adnan.
Thank you, Sumit. Sujit, another portfolio directed query is that what, as per you, are the tailwinds in this calendar year, and what has been the impact of the capex announcement by the government in the budget for our portfolio companies as well?
Yeah, so in terms of tailwind, if you look at the themes, so for example, in this portfolio, I'll just run you to the slide of Psychographics. Just give me a second. Yeah, I hope this is visible. Adnan, I hope this is visible.
Yeah, this is visible.
So clearly, in this consumer durables, we have two names, which is Polycab and KEI. KEI, as I said, is just a recent entry, and these benefits, these businesses have benefited in the 9 months with the capex announcement that have happened. So if you've looked at budget, 35% increase in capex plans of government at 10 lakh crore, and as well as the support to state, that is additional capex, and as well as railway capex going up multiple times in last 10 years. That has also helped. The capex story has played out for some of these cable wire companies as well. So we've benefited there. And since you are asking about the tailwinds, these tailwinds will continue this kind of push from the government. Remember, FY24 again will be an election year. So both in terms of consumption and capex, there'll be boost. There'll be clearly support to rural incomes, number one, and capex support as well that will come from government. So that tailwind will continue. In terms of the themes, even the chemical sector did well. PI industry did well throughout CY22. Their numbers have been strong. Their commentary is strong in terms of our earnings estimate for longer period. It could be northward of 14-15% that we expect for this company. And clearly, China +1 and Europe +1 is playing out for this company. And as well, the other name that we hold, if you look at their numbers, were strong. While the stock did not do much, it was kind of flat in CY22. It is coming out with good numbers. Navin has, done well in HPP products in Q3, with which its sales mix has improved. Margins are up. They've declared capex across 3 verticals of 200 crores. We expect good earnings momentum. We expect good EBIT CAGR of close to 17-18%. going forward for many years. And the stock, according to us, can provide very good returns based on that. And likewise, APL Apollo again benefits in terms of the overall infrastructure addition that is happening, the capex that is happening. They have put out a new plant in Raipur, new product divisions, 3 product divisions, and their current repertoire of products. All of this put together, they are expecting very healthy growth on their volumes over the next 2 to 3 years, and that will also benefit. So basically, these are the things that are basically getting help from the themes that we've played. The tailwinds are expected to continue for a few years to come. And to that extent, it will help the earnings of these companies, compounding of these companies, and in turn, the market capitalization compounding of these companies, and subsequently the return to our portfolios.
Thank you, Sujit. Just a follow-up of what you shared about the key beneficiaries being Polycab. So we can see both Polycab and KEI being part of the portfolio. Any reasons to keep businesses from the same segment in the portfolio?
There are 2 things here. Polycab has entered into FMEG business, so I get exposure to that. And there, while the business does not contribute meaningfully both to the top line and at the OP level. So, for example, the top line of the Polycab in terms of cable wire business would be 12,000-13,000 crores, whereas 1,200 crores is the FMEG business, and currently not clocking very high margins. But there is a significant delta that they're working on taking margins from 3 to 10%. So I get to play that delta in a B2C business in Polycab. Its exposure compared to KEI in terms of B2C is higher even in C&W business. In KEI, I get to play the B2B story. And having said this, at any point in time, we are mindful of the combined weight together, it being in parallel businesses. And so therefore, when we looked at KEI later, we were having the exposure to Polycab. We liked the idea. We decided to continuously monitor the combined weight as well. But at the same time, we did not want to forego this opportunity. And so far, for both stocks, it has played well in terms of returns, both in CY22 and continuing in FY23 YTD. And I believe going forward also in terms of compounding of earnings, both these companies can do that in terms of both earnings and as well as returns for the portfolio. So we did not want to miss those opportunities, albeit keeping our risk parameters in place.
Great. So another stock and sector specific question is that we can see a shift towards telecom with the entry of Bharti. So what do we see changing in the Indian telecom landscape, and which led us to enter into Bharti Airtel?
Yeah, I will first take you to our philosophy. Like I said, while the aim is to generate superior alpha here, we are clearly watching our risks and red flags at any point in time. Some of the, I would say, stocks such as Bharti give protection in down markets to portfolios like these. That was one. Second, importantly, is that if you look at, I would call this a, let's say, a 2.5 player industry where Reliance and Bharti are continuously taking away subscribers and market share from Vodafone. So on the top line, you have this benefit that is coming. While recently, despite the expectation, ARPU increase has not been there, but after a lull of many years, ARPU increase has happened, and it has reflected in the better and healthier operating profit these companies have done. So they have grown faster on operating profit compared to their top line. And when you look at the debt position, clearly now there is financial leverage kicking in as the operating profits increase. To that extent, PBT grows even higher. And the capex intensity has definitely come down. To that extent, free cash flow generation will be higher. So at the free cash flow level, the compounding of free cash flows could be even higher. And that is the play that we have here. And that is the reason our exposure to Bharti. Yeah, done.
Thank you, Sujit. Moving forward, so we can see that Dalmia Bharat as a cement play is part of the portfolio. So just wanted to have a brief on the outlook on earnings growth of Dalmia and the rationale for inclusion in the portfolio.
Yeah. So first of all, here was a company which had significant growth plans, and it is both through organic, inorganic, and it did play out, albeit with a hiccup in between, which I just mentioned to you, that what happened to after the entry of a large group and buying Ambuja, the narrative that got created, and the stock price really came down. But taking that hump out, clearly we believe is that from the vision of the Dalmias to eventually reach a size of 70 million ton versus current 35 to 36, including their announcement of recent acquisition of JP asset, including their position on the balance sheet, which will allow them to basically do some of these inorganic acquisitions such as JP, etc. And at a time when we looked at, there was some room in terms of EV/EBITDA multiple to have gone higher. Today, when it trades at close to 12 or 13 times, even if there is no increase in terms of the multiple it gets, there'll be increase in terms of compounding returns that they can generate. If you watch their Q3 results, their operating profit per ton has really done well. Their energy costs were low. All of that is playing out. Here is a company which will grow definitely faster than the industry growth rate based on their plans of significantly expanding capacities.
Great to know that, Sujit. I think this would be the last question. After value re-rating and below estimate results in the last quarter, how do we see Page Industries spanning out, and what are the numbers that are going to stack up for Page going forward?
Yeah, so as you've seen in 9 months and last 2 quarters also, clearly there is slowdown for consumer discretionary, and to that extent it has affected the volume growth, the top line growth. It has also impacted margins of these companies. Page results were also muted. But like I said, in this a dark cloud, there is a silver lining, in the sense when I look at other innerwear companies, their earnings came down by anywhere between, I think, close to 20% to 80%. Compared to that, Page results were far better. Here is a company which has basically played out its adjacencies very well, from male innerwear to female innerwear, then to kids wear, then to athleisure, one after the other, and all that led by expansion in distribution, especially their expansion in exclusive business outlets was commendable. And there is still some room from there. And so while the stock is at elevated valuation, it has always remained at elevated valuation because it, the competition is nowhere close compared to Page on any parameters. And so therefore, I cannot project and predict, like I discussed with you. CY22 Page did contribute positively to the returns of the portfolio. In CY23, it has impacted the portfolio after the results. Could there be some derating? Maybe there could be. But in terms of the compounding journey that the company is on, continues. And in this downturn, definitely it is done better than the competition. And to that extent, it will gain more ground compared with competition. And so therefore, definitely a certain good growth that it will do in terms of earnings, that much will we hope to pocket in terms of market cap compounding. If there is some derating, the growth in terms of the stock prices or market cap compounding could be a little lesser. But it still continues to be a story that we basically believe in terms of the tailwind that there is there in terms of the growth it can do.
Perfect. So Sujit, well, it seems we don't have any further questions. So thank you, Sujit, for your detailed thoughts on the portfolio and markets. A sincere thanks to all the participants on this call for showcasing their faith in ASK and for taking time out to attend the webinar. On this note, I would like to conclude the session for today. Thank you, everyone.
Thank you, Adnan.